Terra Luna has blown up, Bitcoin is down near 20,000, and ETH is trending towards 1K. Now Celsius is freezing withdrawals from their exchange, and people are wondering, how did this happen? In today's video, we break down how Celsius blew up, other systemic risks in the crypto market, and a whole lot more. Stay with us.
I'm Hannah, this is Erin, and you're watching the Piper Rundown. We analyze business and culture to help you win. Today's rundown is sponsored by Rivers Agile. Rivers Agile merges strategy with engineering to purposefully craft software solutions. Make sure you stick around until later in the video, right before the bull and the bear case, so you can hear precisely how Rivers Agile can help you.
Hannah, when I say Celsius, what do you think of?
The drink.
Oh, interesting.
Yeah.
Thought maybe it would be a means of measuring temperature.
No, because I'm an American.
Okay. Well, neither of those are relevant to today's video. Celsius is a do-it-all fintech platform aimed at helping customers to trade, earn yield, and lend their cryptocurrencies.
Okay.
It is in the process of blowing up. We just in the last 24 hours learned that they have hired attorneys that specialize in bankruptcy restructurings to help them navigate the somewhat hairy situation that they found themselves in.
Oh boy.
The company was founded in 2017 by Alex Mashinsky and David Leon. What they are effectively doing is putting a fintech wrapper on top of DeFi. DeFi is decentralized finance, where in a crypto native environment, effectively anyone with the sufficient technical and financial fluency can gain access to all of the mechanisms of high finance, derivatives, yield farming, all these types of things that have traditionally only been accessible to high finance,
Okay.
and have always required an intermediary, a custodian, some form of an institution to facilitate. Instead, thanks to smart contracts, it's all able to be executed with code and, as I mentioned, a high degree of technical fluency. Celsius's core presumption was many retail investors would love to gain access to the yield, the associated products associated with DeFi, but do not have the technical facilities with which to do so. So on their website, as you can see, they highlight their military grade security and the fact that your assets will be safe forever while you can get access to some of this relatively high yield and associated DeFi products.
Sensing a bit of skepticism here, Erin.
Well, that basically makes them a custodial asset manager. We've covered how BNY Mellon has become a custodian for their clients' crypto.
Right.
So being a custodian to an asset of some way, shape, or form is not that novel of a skill set. They're obviously leveraging this into DeFi, which is not something that, to our knowledge, BNY Mellon has dipped their toe into, and I don't expect that they would anytime soon, especially after this fiasco. But what this effectively does is ring the bell of not your keys, not your crypto, which is a common trope that if you are not the person that owns the access codes to the wallet where that crypto is stored, then you are adding risk to your balance sheet of that centralized entity responsible for your crypto. That comes into stark relief when Celsius last week freezes withdrawals from client accounts, suggesting that they may be insolvent. The likelihood that they're insolvent is pretty high, not only because of that fact on the ground and the fact that they're hiring restructuring attorneys, but also the overall considerable correction downward that has come across the entire crypto market, putting it into a severe bear scenario. When that occurs, here's how that hurts a company like Celsius. Celsius, like banks through time immemorial, have a business model predicated on something called a carry trade. A carry trade basically says, I'm going to take an asset over here that I can get at a relatively low interest rate and bring it over here where there is a relatively higher yield.
Okay.
And if I can manage risk correctly between these two entities, that spread will represent my profits, my bottom line.
Sure.
Banks do this by taking your money, giving you a little bit of interest for that money, and then lending it out to all sorts of different debt vehicles, but most conventionally, most originally for houses or for businesses. the relatively higher interest rate that those clients pay. Some cut is given to those original lenders, but in the middle sits the bank and they make their spread. Celsius was aiming to do the same thing, but we're driving into the DeFi markets in order to get that spread on yield. So they're offering a higher yield than your bank probably is, but they're taking more risk by treading into DeFi. One of the ways they did that is by staking as many as 17,000 Bitcoin, a more than 9-figure sum even when it was at higher prices, and using that in a collection of derivatives and other investments, including something called staked ETH or STETH. Staked ETH is related to a Ethereum mechanism where you can lock up your Ethereum for a period of time, gain a relatively high rate of return for locking your ETH away, but much like a certificate of deposit or other very old school, long-standing methods of putting your money away and earning an interest rate, there is a penalty or a inability to access those funds for a period of time. Certificate of deposits can be 3, 6, 12, 18 months, and you get a little bit higher interest rate. And the basic reason you're paid more is that entity that you're lending to, or the entity that is lending that money on your behalf, knows that there's not going to be a liquidity call on that capital for a period of time. So they can take more liquid bets, make more liquid investments, and get that money back in the future. That's what Celsius was trying to do. Unfortunately, with the decrease in price across crypto, it's now below a $1 trillion market cap industry in total, where last year I believe was over 2 trillion. So there's a more than halving of the entire crypto economy, particularly harshly in the alts, not Bitcoin, not Ethereum. When those prices come down, the debt that has been issued, when an entity like Celsius leverages the assets on their balance sheet, you could leverage a house that's on your balance sheet or a business on your balance sheet. When the value of the collateral for the debt falls below a certain price, you have a margin call, which basically says, hey, you need to either put up more collateral in order to continue this debt, or we're taking the collateral that you've set aside to underwrite the debt that we've given you. At this point, as the person who is getting margin called, you have two choices. And we've made a video in the past about liquidity crises that can kind of get into the thinking here a little bit more detailed, but you have two choices. Either you bite the bullet and you take the L. You sell the thing that has gone bad, get out of the entire trade, and take your loss, take your lumps. The other option, and this is very common, and the reason there are these spectacular implosions throughout history in finance, and the reason it's a highly regulated space, is there's a strong incentive to try and white knuckle your way through the downswing and make it through with your business still intact. You do that by not selling the bad thing, but instead by selling the good stuff that's still on your balance sheet. That not only takes the value, the price of those down, but also allows you, hopefully, fingers crossed, the time for those bad assets to rebound to a better price where you can sell them in the future. That is what Celsius has attempted by not just taking the loss on this margin call, but actually offering up more collateral, which either will save them if there's a massive rebound in price for crypto generally, or if it stays down or continues to go down further, guarantees a massive implosion and a very low likelihood that customers will be able to recoup even 50%, let alone 100% of the balances that they currently have with Celsius.
Ouch. Well, I'm anticipating some painful numbies with Celsius, but let's move on to the numbies section.
So 2 important numbers to start off. At what BTC, Bitcoin price, does a margin call occur? The first, and one of the big triggers here in the last couple of days, was 22,000, meaning Bitcoin falls below 22,000, boom, margin call occurs. It has since been restructured. That next margin call number is 14,000 BTC. Now, Celsius isn't the only player in the space. They're one of the biggest, but they're not the only ones. Michael Saylor and his firm MicroStrategy, which has bought tens of thousands, maybe even hundreds of thousands of BTC, I'm not sure, has their own different margin call numbers. One of theirs, 21,000, has been passed. So he has been a forced seller in some way, shape, or form. His next one is at $3,500. So there's a lot of players in the space that have been trying to lever up. When crypto's in an upcycle, it's nice to get, whatever 100%, 50% gain. If you can use debt to leverage that up and turn it into even more returns, that's how people become billionaires. They become spectacularly wealthy on the upswing in the market, but they experience a ton of pain on the way down. That pain will not be limited to the founders and the employees of Celsius. It will also be extended to their more than 1.5 million customers as of May 2022, who were chasing as high as 18% APR returns and had deposited anywhere from $3 to $11 billion in total assets.
Wow.
This company has raised most recently $750 million of capital at a $3.5 billion valuation last year, and in total more than $830 million. I would feel relatively confident that even those investors will not be seeing much of a return on that equity, perhaps none, and this will only continue to trigger additional blow-ups in the crypto sector, because the first ones to blow up when a market goes down like this are those that took the most risk. And people have been ringing the alarm bell for entities like Luna, like Celsius for some time, because they were widely understood to be taking on enormous amounts of risk for what they do.
Sure.
Downstream of them, you have players that are currently blowing up now. Three Arrows, a crypto hedge fund, that had staked $245 million worth of ETH back when it was multiple thousands. Now it's hovering around 1,000. So they're in the midst of blowing up. Those that took less risk, maybe their liquidation number wasn't 21, 22,000, maybe it's down at 10. They're now starting to become in range, whereas that wasn't really in the cards when BTC was trading around 30, 35,000. So I don't think this is done playing out. I don't think that we have reached the floor for BTC or ETH yet. It's definitely getting closer to buying time. If you aren't a customer of Celsius, if you're like us and weren't buyers of Luna, and you have any cash on the sideline, this is an opportunity. This is where people actually make their fortunes by buying exceptionally low on an asset that they believe can continue to perform in the future. If maybe this proves to you that crypto is just not something that will be relevant in the future, that's your story and you can stick to it. But I think, number one, there's more pain coming. Number two, most Celsius customers will not get much, if any, capital out of those accounts that have been frozen, and that there will be more crypto firms blowing up in the next 6 to 9 months or so, and the pain is not over.
We love the optimistic vibes, Aaron. All right, well, before we move on to the final part of this video, the bull and the bear case, let's hear from our sponsor, Rivers Agile, one final time.
Because you have all these different systems interconnected, bringing a new system in and then interconnecting that it's tough, because you're working with multiple different companies. These packages, especially the new ones, may not interoperate cleanly with some of the other older systems, right? And so you've got to be able to bring those together and really harmonize the whole system.
What else do you have to say, Aaron? Bull in the bear case? I have a feeling where you're leaning.
So the bull case is, there are still players with clean balance sheets. There are still people who are self-custodying their crypto. And that is where, we see crypto that's still not moving. There's crypto that hasn't moved for a super long time, people who are long-term bettors on this. And this just represents a buying opportunity.
Sure.
There have been a multitude of cycles in which there have been severe corrections in the crypto markets. And those that weren't over-levered, those that weren't depositing their crypto into questionable third parties, saw tons of buying opportunity. If you are one of those people, you should be licking your lips. If you have not historically been one of those people, I would start to try and position yourself as such right now in the present. And macro, one of the narratives that, once again, displacements of narratives are where investing opportunities lie. This is a fintech company, a centralized exchange and entity, a centralized custodian. This is not the core thesis of decentralized finance, decentralized investing, or fundamentally the vision of crypto generally. So while some people will use this as the perfect death knell, put the knife in the heart and call it dead, that's not necessarily the case. This is one company blowing up, being allowed to blow up, and hopefully a wildfire that clears the bad players out of space.
All right.
Bear side, I feel like I've already made.
Yeah, I think you have. Well, that's a rundown. Thank you for watching. We would like to shout out a commenter from a past video. Enjoy Yourself said, I appreciate your chill demeanor. The chemistry between you two is entertaining and super informative. Thanks for this video. That's fantastic. We love the good vibes. Thank you for commenting. And if you're still here with us, if you've stuck around for this long, please smoosh the like button. You really make our day. And we'll catch you in the next one.